and a very warm welcome to the three of you. We are joined this afternoon, to my right, by Dominique Carrel-Billiard, Head of Alternatives and Real Assets, Chief Responsible Investment Officer Elodie Laugel, and Head of Fixed Income and Money Markets, Amaury. Thank you for joining us. So, Elodie, I will start with you. We have clearly reached a pivotal moment with regards to the transition at the intersection of geopolitics and economics. So, with this in mind, what would you say are the key trends for investors?
If I'm starting with the most pressing one, I would say that countries and corporate companies are facing now a more adverse climate physical reality change. We have reached 1.3 degree of global warming now, and the highest probability leads us to a 3.6 degree by the end of the century. So we are in a delayed transition and disordered transition that is actually increasing physical risk and transition risk on corporate company, on investment. As a result of that, all the economics and financial figures have been revisited. Now, a 1 degree temperature rise is expected actually to reduce by 12% the world GDP. This is 6 times what we believed in the past. So this is one of part of the context. In front of those challenges, however, we do see some positive development in several fronts. For instance, at the corporate company level, even if absolute emissions are increasing, the carbon intensity, so per unit of business, are following actually a downward trend these last 5 years. It was minus 20% last year. Climate transition plans are increasingly adopted as well. In Europe, you have roughly 60% of the market capitalization that is covered by a climate target. It's more than 40% in the US, and it's already 17% in emerging markets, while it was 4% 4 years ago. So we had this dynamic in the real economy, and finally, it has been touched upon. The clean energy or renewable energy dynamic is definitely a secular trend. There have been some figures dropped earlier. The investment in clean energy that is twice the one in fossil fuel, the 90% of new electricity capability addressed by renewables energy, and obviously on the cost side as well, so should it be solar or onshore, they are significantly decreasing to reach the one of the fossil fuel, even taking into account the intermittency management. So all these trends, I would say, is having consequences for investors. The first one is that in delayed transition, climate risk is further weighing on investment and has to be taken into account for resilience. And the second element is that actually, as real economy is transitioning, opportunities are arising. And a large set of those opportunities are already sizable through climate finance, green bond, blended finance, real asset strategies that are delivering real world outcome.
Thank you very much for that. So let's explore further with you, Amaury. What trends do you see in green and social bonds, especially given the renewed appeal of bond markets following a reset in yields?
Yes, so green, social and sustainability bonds are the perfect fixed income tool to finance the low carbon transition. It is now a super big market with 4 trillion of outstanding bonds, and it has reached an all-time high in 2024 of almost $1 trillion issuance. It is super diversified in terms of products, geographies, and sectors. So green bonds still dominate the market, although there is a growing shift towards sustainability bonds, which year-to-date account for almost 30% of all GSS issuance. Investment opportunities span from developed markets to emerging countries, and Asia, and not only China, but Japan and Southeast Asia have increased massively their issuance over these last years. And this trend will continue because there is a growing shift towards green tech sovereignty that most countries want to achieve. And finally, it is wrong to say that you cannot perform financially with a sustainable approach. As an example, our sustainable flagship on the Euro corporate bond market is outperforming its benchmark, while at the same time its carbon intensity is currently 50% below the carbon intensity of its benchmark. So go green, social and sustainable on fixed income. And as you can see it yesterday with the heat and the storms, the world needs it now.
Absolutely. Thank you very much for that. Turning to you now, Dominique, to explore further the opportunities related to clean energy production and infrastructure. Why should investments in new energy projects accelerate, according to you?
Well, there are several reasons why those investments should grow. The first one, we've just heard it, it's about climate change. And it's about accelerating our way to adapt to climate change. The second one, and we heard it earlier in the afternoon, it's a matter of sovereignty. So as not to depend on energy imports. And overall, as one can see, those investments actually accelerate. Last year, there were $2.1 trillion invested globally in clean energy production and clean energy infrastructure, double the amount that was spent in 2020. So they do accelerate. But the key point for our investors is that there are good financial reasons for that, for those investments to accelerate. The first one is that investing in clean energy production and infrastructure provides predictable cash flows. They protect from downside risk. They are ideal hedges against inflation, which is great for institutional investors who are hedging long-term liabilities. I mean by that, life insurers, pension funds. They provide attractive annual returns. And moreover, they exhibit low correlation with other asset classes, which make them an ideal diversifier in any portfolio to increase your Sharpe ratio. Historically, over the last 20 years, green energy production equity produced an annualized return of 12.3% with an annual volatility of 13.4%. It's the second best pair of return and risk, or risk volatility and return, that you can see over those 20 years out of 22 asset classes, including all the traditional ones. So clearly, it's an attractive case and a strong one for most investors. Investors now have a choice, because those asset classes are fairly diverse, from investing into very core infrastructure, core plus, or value add, with targeted or expected returns ranging from 7 to 15%, depending on the constraints on the investment. Overall, our conviction at Amundi these days is that investors should focus on core plus infrastructure, because they produce what we think is probably the most attractive risk-return trade-off currently.
Thank you very much for that. Clearly some very interesting and compelling figures here, but some challenges remain, especially when it comes to leveraging private finance, for instance, Amaury. So how can blended finance structures mobilize capital for the energy transition?
So first, what is blended finance? So blended finance is an investment approach in which the public sector leverages private money to finance SDGs and climate projects. Overall, what we mean by public sector is development financial institutions, DFIs, and multilateral development banks, MDBs. Those entities have a mandate to serve public interest, such as reducing poverty, promoting sustainable developments, and addressing climate changes. Most of these projects are outside of developed markets, and they may not initially attract private investors because of high risks. So how does it work? The way it is structured is usually with two tranches, a senior tranche, which is safer for private investors, and a junior tranche with higher risk for public sector. So blended finance allows private investors to take risks that they would have never taken otherwise, and it allows public sector to leverage massively their impact thanks to the participation of private money. As an example, Amundi has structured the APGO fund alongside with the AFC, a 1.4 billion euro fund with only 10% of public funding. And this is a leverage of 10. It is our job as an asset manager to find the right trade-off between the level of protection, which is wanted by private investors, and the level of leverage which is wanted by public sector. So blended finance is a fantastic tool to finance SDGs and energy transition in emerging countries, and it must be encouraged.
Thank you for that. Dominique, are there any more private market strategies that we could tap into to accelerate the transition and address this climate financing gap?
Yes, since financing the transition is becoming a pressing issue, the good thing is that beyond infrastructure, our investors have a choice, a broad menu of choice that cuts across all private markets. Effectively, it's a theme that cuts across private equity, private debt, real estate. So you can do good things in all those categories. Private equity, it's what I think people call impact private equity. So effectively investing in companies that either provide a technological solution to the energy transition or in companies that radically transform their carbon footprint and their operating processes, as well as companies that are in the circular economy. So the intention of private equity investors when they go for impact is to produce the usual outstanding returns that one can get from private equity with a positive impact for our environment. The second one is private debt, which, like Amaury said, practices the notion of sustainability-linked loans quite heavily, where the margins on the loan can be adjusted upwards or downwards, depending on the borrower achieving positive impact, environmental or social. And lastly, and it's probably the most important one, we can make our buildings greener. If you retrofit a building, an office building, with LED lighting, you can reduce its energy emission by 13 to 19%. It's quite a massive amount, and clearly a good example of what can be done in private markets to foster the transition.
Thank you very much. We need to wrap up this conversation. Elodie, what should investors keep in mind to make the most of the opportunities of the transition?
I would say that the climate finance toolbox does exist. This is really our conviction, enabling to build resilience, capture opportunities, and allocate capital where the financing needs are. The second element is that adopting a diversified approach is a must-have, actually, to leverage those opportunities in different sectors and geographies, contributing to the transition. The third element is that integrating climate risk as well as climate transition plans, so the forward-looking dimension is critical for us in each and every security analysis, corporate company analysis. And finally, that the climate shareholder dialogue is a critical lever to accompany company in their transition journey and adaptation process to this, in front of these delayed scenarios. All in, I think, and it has been said, so I'll repeat it, but climate finance is not only about finance. We've heard about energy sovereignty, strategic economy, competitiveness, economic growth. So tackling climate change through targeted financing is not only an environmental imperative, but a matter of economic stability and prosperity.
And on that line, we have to conclude this conversation. Many thanks to you. I think it was quite encouraging, actually, I must say. So many thanks to all of you, Dominique, Elodie, and Amaury, for your insights.